So tell me a little bit about yourself and kind of what brings you to us.
I'm having trouble with retaining the information that I'm studying because I felt a little bit overwhelmed with everything. Okay. And then I think it's taken me, because I've been out of school. I got my master's in 2013, so I've been out of school for 5 years. I work full time. I have 2 kids. And so I find myself not being able to pick up information as quick as I used to. So I'll probably spend longer on understanding and stuff probably than, I don't know what the average person would take, but I feel like I have to go over it several times for it to click. Got
it. All right, so I'll tell you what we're going to do. Let's jump into, you particularly brought up a topic of mine that I would say 95% of the people have issues with cash flow. The only difference is 50% of those people don't know it. Okay? So let me explain what I mean by that. So what I mean by that is this, is that at the end of the day, most people, now, what are you using to study?
Wiley CPA.
Okay. Now, let me explain something to you. I mean, their approach is real simple, right? You memorize, AP is a decrease, and all that fun stuff, right?
Yeah, and that's not what but that's not how I want to learn it. Because I know that this is decreasing that, but I want to know why.
Okay. So
I can remember that. I remember that, but I'm like, but why? Because if I have another question, I need to know why.
Okay. We're going to look into exactly the whys behind cash flows. And in order to do that, okay, we have to talk about a little something to start, which is, what is a cash flow? Tell me, what is a cash flow? Yep.
A cash flow is the cash activities that came in and came out of a company during a particular, I guess if you do it annually or quarterly, it's letting you know what came in and what came out.
Good. And that's the answer that most people give me. Okay. But there's a better explanation. So I'm gonna pull up a Excel document, which, by the way, when we're done, I will forward it to you. So it's your little memento, and it prevents you from having to take notes. All I want you to do is pay attention. So tell me when you see the Excel document. Okay.
I see it.
The purpose of cash flow is to tell me the real balance of cash available. Now, let me ask you, let's back up 1 second. So essentially, a cash flow is a reconciliation from net income to get to the cash number.
But when you say the real balance, doesn't the balance sheet show the real balance of cash?
But the question is not what's on the balance sheet just yet. The cash flow statement wants to reconcile. It's sort of a disclosure. And it wants to reconcile net income into cash, so this way it ties to the balance sheet.
Oh, okay.
Okay, let me explain. So what I'm going to do for you is, because in order for you to really understand cash flows, you have to draw what I like to call mini financials. I'm a big fan of mini financials, and I'm going to tell you why. As we go through some questions today, we are going to look at the impact on the financial statements as a whole, and that in itself is going to help you understand the purpose of cash flows. And I'm going to talk about that in a second. So, balance sheet, okay, and then you have income statement, and then you have cash flow. Okay. What's the formula that you're used to? Assets?
Mm-hmm.
Then you have what? Liabilities. And then you have
equity. What? Shareholders' equity.
Right. Right? Then you have, over here you have revenues. Then you have expenses, which gets you to net income. Then you have cash flow. Before we get to cash flow, let's have a quick conversation on the balance sheet and income statement, and let's understand the way this works. To really, because we can't have a conversation on cash flow unless we understand the way the financial statements work as a whole. So I'm going to throw out an entry for you. Okay? The entry that I'm going to throw out to you is a cash sale. Okay? Now tell me, from your experience, okay, what is a cash sale? What's the entry for a cash sale?
A sale meaning I made a sale?
Yep. And for simplistic purposes, we're not going to get into cost of goods sold. We're just going to talk about the entry for a cash sale.
Okay, so I would debit cash and credit revenue.
Debit cash, credit,
sales
revenue. Good. Now, this is the fun part. Let's put that on the balance sheet, on this mini financial statement that we've created. Okay? So, cash, $100. Sales revenue. Cool?
Yes.
All right. Notice that the balance sheet, right now, everything that you learned in school is not being understood right now. Meaning that you have $100 as an asset, but your assets don't equal liabilities plus equity.
Plus equity, right?
Why is that? Have you ever thought about this?
No, I haven't. No.
But yet you know the entry inside and out.
Yes.
So I always find it amazing that people come to me and they can spit this entry off the tips of their tongue so freely. But then when I ask them the follow-up question of how it flows into a financial statement, which, by the way, the exam with the simulations and everything that's moving towards more understanding the financial statement impact, because that's what the AI CPA cares about, making CPAs that could read and write in the financial statement language.
Okay.
So tell me, at this point, why does it not equal? And maybe you don't know.
I would say why is right now because I haven't incurred any liabilities. I just made a cash sale.
Okay. Well, that's why I specifically, I use the transaction in its most simplistic form, just a cash and a sale. In the rare circumstances, there's no cost of goods sold, no liabilities. We're just isolating the problem. The name of the game. We're isolating the problem. The problem is that our income statement will eventually equals, right, the sum of the expenses, and obviously for purposes of our demonstration here, we're going to do expenses as a negative number, right? So how much net income do I have? We have no expenses. Sales revenue is $100, right? So net income is $100. Let me ask you: have you ever heard of the term that the balance sheet is a point in time?
Yes.
And the income statement is a period in time. What does that mean to you? I'm sure you heard this term over and over again in school.
Yeah, and I never.
And if you read it,
doesn't seem like.
And if you read it, and every CPA review book is going to say this, but nobody ever explains what it is.
But it doesn't seem like a point in time. They seem like.
Okay, so let me explain. Okay, the balance sheet is an ongoing, perpetual accounting.
Movie. Okay.
A perpetual accounting of a balance from the beginning of time to the end, where there's no balance.
Okay.
The income statement only counts for the year that you're measuring. So if I ask you at the end, year one revenue was $100, year 2, revenue was $100, okay? Do you say at the end of year 2 that you made $200 or you made $100?
100.
Why? Because you're only measuring that period in time.
Yes.
Okay? So, at the end of this period in time, okay, we are going to close out net income into retained earnings. Let me show you what the entry would be. The entry would be sales revenue, in this case, would be net income. Now, this is essentially a what? A credit or debit?
Credit.
Good. So this is going to be a debit.
A debit.
And now we're going to do retained earnings, $100. And so the closeout entry, right, or we're going to say the closing, and by the way, as I'm going through this, excuse me if I misspell anything. Obviously, as I'm going through this with you, I'm focusing on teaching you the concepts more than the spelling. So as long as you can make out what I mean to mean, then you are in good shape. Does that make sense?
Yeah.
All right. So this will do $100 here. And now we've essentially just cleaned out what's our income statement? Zero. Right? Fresh to go, ready to record next year's or periods in time. And my balance sheet now equals. That's the magic behind retained earnings. So this would actually be retained earnings. Now, cash flow. So I want to, just for purposes of our example, I am going to remove cash flow from here, and I'm going to put it, I'm going to label it over here, and you're going to see why in a second. I need that space because, let me ask you, cash flow. What are the different parts of a cash flow?
Operating activities, investing activities, and financing activities.
So you have operating, investing, financing, right? Then you have a total number. Which is total cash flow. Right?
Right.
You were on the money before when you said the whole point of this was to go from your total cash flow number should equal exactly what's on your balance sheet. So let's use an example that we just did, right? So forget about the retained earnings aspect. We don't care about that. That was just informational for you to understand the way a financial statement works. Now let's get into the nitty-gritty of a cash flow. So in this example, your entry was cash and sales revenue, right? Let me ask you, talk to me a little bit about, have you taken the reg exam yet?
No, this is my first part.
Okay, fine. Studying. So cash basis financials means that whatever the net income number is, that is exactly what my cash is. That's what makes it cash basis, right?
Right.
GAAP has these funky little items called accrual items. You know, you have accrual, you have AP, you have AR. You have these numbers and these items that don't necessarily make sense because they don't correlate to cash. They correlate to the matching principle, which really just means that revenues should be associated with the related expenses and vice versa. Okay? So what I mean by that is let's just say, for argument's sake, that you didn't have a cash sale. Let's say it was a credit sale. Okay? It was a credit sale. So credit sale means that, well, you have AR, right?
Mhm.
So instead of cash, we're going to have AR. So I'm going to take away the $100 in cash, and I'm going to put a debit to AR. Do you see what I did there?
Yes.
Debit to AR, credit to sales revenue. Right?
Mhm.
Okay. Let me ask you now. What does it say you have in net income?
100.
Oh, boy. And if I was to say, all right, now you have $100 in net income, go pay your bills. Can you pay your bills with this?
No, I
Why
can't.
not?
I don't have any cash.
Oh, boy. So for the first time, we're starting to realize that it's not about what you have in net income that matters. And why do we care about having cash?
Because just like you said, you want to be able to pay bills.
Right. You can't pay bills if you don't have the cash. And why is that important for a business? Because if you can't pay, let's say, debt, you go into default. You go into default, your interest rate doubles. Not only does your interest rate double, but now you go, you get slapped with different kind of litigations, right? So now
Right.
it's the beginning of the end. So if I'm an investor, do you think it's important for me to know if there's cash to pay the bills?
Yes.
Absolutely. In regardless of the fact that I have net income, I want to know, is there enough cash? And so, like I said, if it was a cash basis financial, you wouldn't have these issues, because the definition of cash basis financial is your net income is your cash. But all of a sudden now, when it comes time to GAAP, we see that there are circumstances where you don't have the cash even though you have the net income. The purpose of the cash flow is to bridge the gap from net income to cash flow. It's that simple. So let's try it out right here. Okay, what would you do here? So my cash balance, based on our transaction and only our transaction, there was zero impact to cash. You with me?
Yes.
My net income says $100. And by the way, watch what I'm going to do with cash flow. I'm going to sum up the total net cash flow to net income. So essentially what happens is you have a reconciliation that comes from net income down to total cash flow. So right now, if I didn't prepare a cash flow, the average non-CPA candidate, the average non-CPA would say, how much money do we have? $100. But me and you know that's not true. Based on this transaction, there was $0 in cash. So therefore, an increase or an AR increase really needs me to decrease my AR to get me to my magic number of 0. Now my total cash flow equals the cash on my balance sheet. That's what you said you wanted to do from the beginning, right?
Right.
These two are our magic numbers. We always keep our eye on this. If you get a simulation on the CPA exam related to this, you know that they'll give you the cash flow and you have to create the cash flow. Everybody knows that. But what you don't know is that the number that they give you on the balance sheet, that's the total answer for the cash flow. Now, obviously, you can't come in here and they'll give you the balance on the balance sheet of cash of, I don't know, $489, right? I'm just making this up. And then you come over here and know that your cash flow has to also equal $489. But you can't type that in. It's got to be calculated. But the point is that you have a little cheat sheet. You know the answer. You know that my cash flow, even though you're calculating it, has to equal my balance sheet number. And so we will keep an eye on those on every question that we do. Okay?
Okay.
So now, tell me why my AR increased. Let's just reiterate what we just talked about. Tell me why we made a decrease of $100 to get to AR. In your own words.
And because we didn't receive cash.
Right. So we want to make this total cash flow number correct. If I didn't do this, make this adjustment, it says I received $100 when I really didn't.
Right.
So I'm not memorizing here. I'm not going to tell you what everybody else tells you. Whenever you see an AR increase, subtract out $100. Thank you very much.
Yeah.
But why? I just told you the why. Because the point of a cash flow is to reconcile net income to total cash number, period. Okay? Making sense? I'm going to give you some more examples. So let's just...
Yes, yes, thank you.
Okay. So now, let's go over another number that people always forget about. Let's say that so now I always do each one separate. So I'm going to take away this, I'm going to take away this, I'm going to take away the effects, and let's talk about depreciation expense. Here's another good idea, okay? What is depreciation expense, in your own words?
In my own words, it's what can I say, expense that you can't see?
Well, always in relation to the cash flow. Let me give you a more specific question, okay?
Okay.
Depreciation expense is an expense, but now, you ever bought a soda can out of a soda machine? You ever go and like put the dollar bill into the soda machine?
Yes.
You slide your dollar bill into what they call a dollar validator. So are you telling me that you go up to the side of a building, and when it says, okay, time to pay your depreciation expense, do you actually slide dollars into the building?
No.
Right? Sounds silly. So let me understand what you're saying. So are you telling me in a roundabout way that, yeah, you're right, net income will show a depreciation expense, make up a number of $15, but there's no cash impact, right? Because the other side of the entry would be to accumulate depreciation for $15. Right? The entry, the full entry would be what? Accumulated depreciation.
And depreciation expense. Credit for accumulated and debit for depreciation.
So now, let me ask you, what does my net income say? That I got an expense of $15. But how much cash did I receive from this transaction?
0.
So I know I got to put a positive 15 or add back depreciation in order to make my total cash flow work. See that?
I see it.
Cool, right?
Yes.
We're not talking about memorizing here. I could say to you, whenever you see depreciation, make sure you add it back. Thank you very much, but why? There's the why. Right?
Right.
Okay. Now, so this is a little bit of an intro, and I promise you that by the time we're done, we're going to go into some multiple choice questions, and you're going to be able to get every question correct without knowing, well, without memorizing a blessed thing. Okay?
Okay, because I
That's
don't want
the
to
goal.
have to remember. Yeah, that's the goal, because I'll forget if I memorize.
Listen, this is one little topic of many big topics. And so if we have you starting to memorize now, by the time you get to the exam, good luck. Right? Most people tell me, oh, I knew cash flows when I did it 6 weeks ago. When I got to the exam, I'm like, wow, I wish they would have asked me this question 6 weeks ago. What good is that going to do? Right? What good is the fact that you forgot it by the time you went to the exam? Well, the other reason why you forgot it is because you never really understood it. We have to be able to understand what we are doing in order for you to apply this consistently on the exam. And guess what? Not only to apply it on a multiple choice question, because that's the easy stuff, to be able to apply it on a simulation. Okay? To be able to apply it on a simulation is really the main goal that you should have for every topic, if you can answer questions from a simulation or understand it to the point where no matter what the question I ask you, you can answer it, then it doesn't matter if I ask it for you in a multiple choice fashion or in a simulation fashion. Okay? Now,
Okay.
all right, so we just got into this conversation, if you will, of what cash flow is. And finally, you're starting to understand that it's not really, you're so focused, people are focused here on a cash flow question.
Mhm.
They really should not be talking about the cash flow. They should be talking about how is the entry booked before it gets to the cash flow. Because all the cash flow is an unwinding of the initial entry to reflect the true cash balance. Let's talk about some parts of the cash flow. So enter operating, investing, financing. Okay? Those are our three main characters. What is operating?
Operate are the expenses you use to operate the business.
Well, it's not about expenses. That's if I was to say to you what's operating expenses. I'm asking you for the operating section of the cash flow statement.
Operating, that's what encompasses just operating the business.
Yeah. So I always ask myself. Go ahead. Talk to me.
Go ahead.
I always ask myself, what am I in the business of doing? I'll give you an example. If I'm Amazon, what is Amazon in the business of doing? Selling commodities, books, now videos, right? That might be a bad example because Amazon just does so much now that at the end of the day, what doesn't Amazon do? But I could tell you that in terms of Amazon, okay, you have to understand that whatever is related to the business of selling stuff, okay, is an operating expense or an operating revenue. So anything that's related to the operations of the business, okay, should go into operating. Okay? So I'm going to define broadly, operating is any activity that leads to the production of revenue, open parentheses, in the form of its normal business operations. Now, why do you think I make that statement and I say it like that? Let me explain what I mean by this. Okay. What do you think well, let me switch gears and then I can go back to because in the codification they actually how they explain this is funny how they explain what operating is. They say that operating is everything that is not investing in financing.
Okay.
Thank you very much, right? That doesn't really help me, right? Because you need to distinguish them up front. So let's go into investing. What does investing mean?
Investing is any, activity that a company, uses to make money. They want to invest in something to get a return on.
Yeah, okay, good. The company investing in themselves, but not really in its core business.
No. Yeah. Okay.
And we'll say that the company has the intent to make a return. Okay? By the way, while we're on it, even though it has the intent to make the return, once it makes the return, that return is considered operating. The selling of that investment is still investing.
So why is the return considered operating?
Yeah. So this is one of the exceptions, not exception, but I look at it as an exception, on the core understanding that we want to say that, think of it like this, okay? Think of they buy a piece of property, let's say equipment. They buy equipment, okay? Let me give you an example. They buy equipment for $10, and then they sell it for $20. So sale proceeds is $20. That's cash, right?
Mm-hmm.
The carrying amount, I'm making this up, on the books is $15. $15,000. They have a gain on sale. Is that correct?
Yes.
Of how much?
5.
Okay. So the theory is, before we get into what a gain on sale is, so the gain on sale, okay, that's a bonus. Why do you think they bought this equipment? Do you think they bought this equipment because they're in the business of buying and selling equipment?
No.
They bought the equipment because they felt like, now let's go through the alternative. If you don't buy the equipment, you have to go rent the equipment, right?
Yes. Yes.
And if you rent the equipment, isn't that an expense?
Yes.
Oh, okay. So what you're saying is that we made an investment to get a return, but also to save on an expense, because anything that a company is going to invest in is going to be related to helping them with their business. So Amazon might buy trucks because now they want to start to deliver. So instead of continuing to pay UPS, FedEx, and all these companies and generating operating expenses, they say, well, now we're going to buy our own trucks. So they invest in buying trucks, but do you see that the core investment is an investment? Anything that it makes off that investment really helps their bottom line, because they're probably saving in operating expenses that they're not paying now.
Okay.
So when I buy the equipment, there's no question that it goes through investing, the truck. When I sell the equipment, the monies that I get, let's go through the entry, okay, on this example. The money that I get, so we're going to say cash proceeds of how much?
20.
Good. And what did I say the carrying value is?
15.
Good. And that means that this is a gain on sale, right?
Right.
So that means you have 5 here, right?
Right.
Let's go put it in. So let me just delete all my previous information. What's my cash number that I got?
20.
20. Good. What's my carrying amount? So that would be considered an asset, right? Carrying amount.
15.
That's a negative 15 in this transaction, right?
Mhm.
And what's my gain on sale?
5.
Now watch what happens when I put this in. My 5 gets the net income. My net income, supposedly, because remember, the unsophisticated person would say that, oh, you got net income, you have $5 of cash, right? But
Right.
what do you know? You know that we have
20.
Right. So now the question is, what do you do? This is a 2-part question. There's only a few of these, so I'm just going to talk about this one slowly. The first thing you're going to do is you're going to unwind
The 5, right?
the 5. So gain on sale. And why do we say that? And a lot of people ask me this question. Well, Joe, what do you mean by unwind? Well, think about it. When I sold that property, I'm getting proceeds for that property, so that should go through investing. But the gain is a fictional gain, right? Did you really get a gain? No. that gain is only there because the recorded carrying amount
is different.
Is different.
Yeah.
Okay?
Yes. Mm-hmm.
So this, in reality, we want to, remember I said that a cash flow is really the unwinding of the entry. See, nobody talks about this entry. How do you do cash flows if you don't talk about the initial entry? It's all in the initial entry. If you go, and I promise you, if you plug in every single time what the initial entry is, the cash flow figures out itself. So now that you have $5 over here, now you say, oh, well, total cash flow is 0. That's right, because now you have proceeds from sale of equipment, which is the real $20,000 that you got. Follow the cash. That's your impact. That right there is the hardest question on the CPA exam when it comes to cash flows, is understanding that there's a two-part, right? Try to memorize this. Go ahead, right? How do you even memorize that?
You don't.
You don't. You just don't get it right. But that's okay, because understand that when you're trying to create materials for everybody, sometimes they don't even teach this because they're like, it's not worth it because it's going to confuse people, so we'll just leave it out. Now, so we talked about the return is operating, and the selling, or the cash, or the sale of the investment is an investment. Let's go over financing. It's the easiest one. It's my favorite one.
Your favorite?
Yeah, raise capital. You know why?
Why?
Because these two cause me to go have to take 2 sips of water after I'm done explaining them. This one, I'm ready to go. That's it. Raise capital. Cool?
Cool.
Any questions on the 3 sections of the cash flow?
No.
All right, let's break it down a little question. If you want to write this down, or step 1, classify.
You want me to write it down?
Yeah, you're going to get a copy of this. It doesn't really matter. Classify. Okay. Every question you do, you're going to use this format. Step 1, classification. Cool?
Okay.
Step 2, please, pretty please with a cherry on top, understand the initial entry. Step 3, unwind the income statement impact to match the actual cash. Step 4, enjoy not memorizing. Okay?
Okay.
No memorization. We're just going straight into understanding each one. And we're going to apply this. So don't feel like, oh, all right, Joe, you showed me 2, but, you know, is this really going to work? Let's check it out. Cool?
Cool.
This little thing that I'm doing here on the Excel is really, I mean, there's not crazy formula. This is easy stuff. My goal is when you get a question on this, see, because if this was a simulation question, they could ask you questions like, oh, what's the balance of the carrying amount of the asset? And if you don't do this, you're really at a disadvantage because you don't see the whole big picture. And you have to train yourself. See, this is what, you know, the one question I get the most is, oh, I'm horrible in simulations. I'm like, okay, well, if you really understand the material, does it matter how I ask it?
It doesn't. It shouldn't.
It shouldn't.
If you understand it.
If you don't understand it, woo, now all of a sudden, now it matters, right? Because did you know if you don't know a multiple choice question, you have a 25% probability of getting it right. Right? 1 out of 4. You can guess and get it right, even if you don't know it. With the simulation question, where you got to type in numbers, the answer choice can be from 0 to infinity. The probability of you getting that right is zilch. If you know it, it does not matter if I give it to you a multiple choice or I ask you to type out the answer. It is the same. So in terms of simulations, now there are things that you can do with simulations to really hone in on how they're asking certain things, and we'll work on that. But the most important thing is understand the topic inside and out. Don't memorize, and you should be fine. Cool?
Cool.
Let's actually try to do a little workout with this. You ready?
Ready.
All right. So far, how you feeling?
Great. Thank you.
Next. Okay, first question. Read it out loud. The way this works is you're going to read the questions out loud. Joe, why am I reading it out loud? You're reading it out loud, right? Because I get a lot of information from hearing you talk. The sound of your voice. I've done this long enough to know when somebody is reading scared, reading confidently, or reading without knowing what they're reading.
Which of the following transactions is included in the operating activity section of a cash flow statement prepared using the indirect method? So it's asking me about the operating activities, which transaction would be included in the cash flow in the operating. So gain on the sale of plant asset, that would be operating.
Love it. I'm actually going to do it with you. O stands for operating. Next one.
The next one, sale of property, plant, and equipment, is investing.
Good. Why? Why do they invest in that? They invested in the property and equipment in the first place because why?
Because that'll help the business make money instead of.
Love it.
Yes.
Right. All right. They're not investing in stuff because they want to, act cool. Or, they don't want to show. They invest to help the company make money in their normal operations, even though that investment itself, right, buying equipment. Now, let me change that because there's a couple of other questions that we have to get to related to available for sale trading securities. Have you heard of these terms?
Yes.
Okay, I'll tell you what they mean in a bit because we're going to do a question on it. But
okay.
The number one thing that I want you to pull out of this question at least is that you understand that there's companies that buy and sell trucks for a living.
So that would be their normal operating.
Ah.
Right.
Yes. Okay. Now I can buy a truck if I'm Amazon, and all of a sudden that's investing. Woo! Right? So you see how the facts of the question can, and so if you're stuck memorizing the definition of investing based off of a sentence in a book, good luck.
Because it could ask you about a business that does this on the normal.
You have to know the purpose of what investing means in order to classify correctly, and then you got to be able to apply it to different circumstances on the different facts that I give you.
Mm-hmm.
Next. I love this. I love taking a multiple choice question and turning it into essentially a simulation.
Okay, so payment of cash dividends to shareholders would be financing.
Good. Why?
Because they bought shares from you. They bought common stock from you, and you're paying them.
And by the way, when they say they bought common stock, right? They didn't.
Mm-hmm.
They bought common stock because you sold it, and you sold it because you wanted to raise capital.
Right.
So anything associated with that raising of capital, i.e. the paying of the dividends, the issuing of the stock, all financing. So these two suckers are financing.
Okay.
Cool?
Cool.
The first couple questions that I'm going to do with you is just related to, we're going to get some flexibility here with understanding the classification. Once I know that you're good with classification, we're going to jump into calculation questions. Once we jump into calculation questions, it's game over. All right?
Okay. Should I read?
Yep.
Okay. Interest paid to bondholders is reported in connection with a statement of cash flows as. So I'm paying interest on a bond. So that's a bond payable, right? to bondholders.
Yep.
Yeah, okay. So that's a bond payable, meaning I issued a bond. Okay. So the interest payment on that, with that, I would say it's an operating activity.
Yeah, and people get this wrong a lot because initial reaction is sometimes you want to say it's financing, right?
Right.
But notice that that isn't an answer choice, and that's done on purpose. Okay, that's not an answer choice. But number one, let me explain why it's not financing. So bonds, right, is like debt. And what's the reason why you take out debt? To make money in the business.
Right.
So the interest associated with that debt is going to be operations, because you wouldn't take on that debt unless it was part of the operations.
Okay.
Want me to explain it to you a little differently?
Yes.
Okay. You see? It's all in the voice. Okay. Assets. And I know my handwriting is atrocious with the mouse, but liability, right, equals equity. Anything that goes on in here is related to the business. This is related to the owners, right? In the previous question, when you give debt, when you raise money through equity, everything associated with that is finance. With bonds, debt, the initial issuance is related to finance, but because the normal classification
I see that. Oh, okay, I'm sorry.
of interest that comes in that goes into operations.
Oh, yes. Okay, okay.
Isn't it amazing? A couple of circles and a square, and all of a sudden you understand something that you could probably read about for 3 days and probably not get an answer to?
Yes. Okay.
Okay?
Let's
keep it moving.
Okay. Okay. Investment revenue is reported in connection with a statement of cash flows as B, an investing activity.
Remember we said, what was the purpose of you investing?
To save money.
Right.
No, I'm sorry. Yeah.
To save money, right? Because think of the Amazon. Amazon is not in the business of buying trucks, so that's why if they buy a truck, it's considered an investment, because they normally would use UPS, right? So isn't this exactly that same question, where the revenue, okay, the revenue associated with it is an operating activity, because the whole point was to reduce the expenses that you have on your operating statement.
Okay, so let me.
But if I sold, let me go back to the point. I think where you're getting.
Yes. Okay, go ahead. Okay.
This. If I change this.
Oh, I see what you're about to say. Okay.
To gain on sale.
Okay. Oh, I get it.
Okay.
Now that's investing.
Well, no, the gain on sale is always operations.
Oh, yeah, the gain on sale is operating, yes. But if you sold it.
Well, actually, understand this. When I say the gain on sale, you have to remove.
From operating.
From operating, because of the impact that it had. Let me just bring it up. The proceeds goes in investing. there's two things that you got to look at when you're unwinding this type of question. The proceeds go to the actual investing. The change on gain of sale is simply the unwinding from the operating section that happens based off the gain on sale calc.
Mhm.
You get what I'm saying or no?
Yes, I do. So the investment revenue is not me selling anything. It's just me getting revenue from that investment.
Yeah. So let me go back to.
Okay.
Let me go back to this, and let me. Can I, if you don't mind, I want to do something. I want to contrast this question. I'm going to come back to this question in a second. See what this question tells you: investment revenue. Okay, does not mean. Listen to what I'm saying. Does not mean that you receive cash dividends.
Okay.
Because if you receive cash dividends, that's part of operations, right? Because anything that you make off the investment that you make, any revenue that comes in as associated with the investment is considered operation, right? The actual investment money, if you sell it or when you buy it, that goes through investment. But any money that you make is part of operations because the only reason why you made the investment was to
make money.
Make money. Okay?
Okay.
Now, let's go back. Look at this next question. Read it.
March 3rd, year one, Batista Company purchased 35% of the outstanding common stock of Granite Company. During year one, Batista received a $40 million cash dividend from Granite. What effect did this dividend have on Batista's statement of cash flows for year one? So, March 3rd.
Notice that this one says cash dividend.
Mm-hmm.
So they received cash, right? And what do we say when you receive cash related to investments that you made?
It goes to operating.
Bingo. Now, all right, so let's have a conversation on held to maturities, trading security, and available for sale. Okay, let me pull up my sheet here.
Okay.
All right, so they love to ask these questions. So I know that we haven't touched on, so usually what we try to do, trading securities, available for sale. So technically I would have liked to have covered this topic with you, right? But since your main concern was cash flow, I'm cutting out everything else, and I'm about to teach you trading securities, available for sale, and held to maturity in a couple minutes flat.
Thank you, because I didn't tell you everything I was having issues with, and this is one of them.
Okay, so here it comes. Trading securities. You're gonna. I mean, it's amazing on how this all links up with what we did in the cash flow so far. Trading securities is now, in all three of these, they're investments that the companies hold. So you can buy a stock, and that same stock, depending on the company, could be classified as each one of these three items.
Okay.
Good news is, in terms of the cash flow, they never ask you any questions on held to maturity. But I'll leave it up there just for completeness purposes and teaching you the difference between all three. Trading securities means if I buy a security, okay, and I'm going to actually make a line here. Trading security, and then I'm going to say that if I say that you bought a security and there was a change in fair market value, you ever heard of a realized or an unrealized gain?
Yes.
What is it?
A realized gain is a gain, I would say, that maybe you sold your stock because there was a gain in the market and you sold it.
You sold it to an independent third party. It was a real sale. Then you're going to realize a gain.
And you got the gain.
Right. If it's unrealized, what is it?
Meaning that you haven't sold the stock, but
right.
It's worth more than what you paid for it.
Exactly. So, because of this, well, it can be worth more or worth less, right? So you can have an unrealized loss or an unrealized gain, okay? But the moral of the story is that technically, based on GAAP, this is not IFRS but based on GAAP, right, you have to record this change on fair market value in some manner. Now, trading securities means that I'm going to make a little spot over here. I'm in the business of buying and selling securities. If I'm in the business of buying and selling securities, guess what? Whenever there's a change in fair market value at the end of the year, I'm going to record that on the income statement. Available for sale, I'm not in the biz.
Oh, okay.
Where does that go? OCI. Bam. Big time discovery here, right? Because now, when we come back to this, my net income, if I'm recording something on my equity statement, remember over here, it never hits my net income. Holy moly. So that means that it's not going to come into consideration when I go down to calculate my cash flow.
Okay.
But when I do something with trading, it does.
It does.
Now, remember that this is for cash flow purposes. A change in fair market value is different than saying that you have dividend revenue. Dividend revenue will always be income statement for purposes of the cash flow. They like to mess around with saying that, oh, you have cash, so people, when they read the questions, they don't realize that if you try to memorize that available for sale is always in OCI and not in net income, you're going to get stuck because sometimes you can have dividend revenue. I'm not talking about how to handle this for purposes of actually recording it. That's a whole different discussion. But for cash flow purposes, this over here is really a return on the investment, and that goes into operating. But the change in fair market value, or an unrealized change in fair market value, does not go into operating. Well, it depends. If it's trading securities and they're in the business, it goes into income. If it goes into available for sale, it's OCI.
Okay.
Cool? Now, just as another little reminder, okay, OCI, the gain goes into OCI. I should really put this down over here, right? A loss is always recorded on the income statement.
So, okay, so the gain on available for sale securities goes in OCI.
Yes, and we have we should probably have another session just on that for me to be able to clear up all of that. But for purposes of the cash flow, this is enough to be able to answer the questions.
Okay.
Let's try to go back to. Okay, so read this.
Cash flows from transactions in which of the following securities are most likely to be considered cash flows from operating activities? B, trading.
Bingo. Cool? All right, let's get busy here.
Kevin's company reported net income of $30,000 for year end. During the year, inventories decreased by $7,000, accounts payable decreased by $8,000, depreciation expense was $10,000, and a gain on disposal of equipment of $4,500 was recorded. Net cash provided by operations at year end using the indirect method was. Okay, so what I would start off is asking for indirect method. I would start off with the $30,000 of the net income, and then either add or subtract my inventory
So you want to do the first one together?
Yes, please.
All right. Okay. So the first one, I'm going to start it down up here because we need the room.
Okay.
I know it's hard to see, but it's 30,000. Cool?
Mhm.
Okay. Now, I'm going to pull up. We're going to take each one separately.
Okay.
Inventories decreased by 7,000, right?
Right.
Okay. So let's go to my book. Okay. Let's plug it in. You ready to go? So I'm going to clear out. This is everything we practiced for, right? It's all going to come together right now.
Okay.
So what do we say? Dividends decreased by what?
Inventories increased by 7. Did it increase by 7,000?
No, I think it was decrease.
Is it decrease? Yeah. Okay. Decrease.
So what's the entry? Notice. Listen to what I'm saying to you. I'm not talking to you about cash impact yet. Do not talk to me about cash flow. Because if you go into cash flow off the bat, now you have to memorize.
Yes.
We don't want to memorize.
No.
So talk to me.
So
what's the initial entry?
Meaning I sold some inventory.
Right. So
right.
I love it. So inventory, I always do it on the bottom if you want to in the beginning. This is right now we're just getting into the training wheels part of the show, right? Where we're going to do it nice and slow, and then eventually we're going to be able to break off the training wheels and just do it directly. Okay. Inventory decrease, which would be a credit.
Mhm.
And then you have what?
Either I got cash for it.
No, that's not the sale. So the sale goes to revenue. The inventory goes to cost of goods sold.
That's right.
Okay. So let's real quick before we move forward because I want to eliminate this problem. I love to eradicate problems. I really do. So let's go over the complete sale of a product. Sale, right? If you going to do a cash sale, you have what?
Cash.
Let's say cash. So you're gonna receive cash. I don't know, for $10,000, and then you're going to have sales revenue of $10,000 credit, and then and let's just say you sold it for $7,000, then your cost of goods sold would be $7,000, and your inventory goes down for $7,000. Let me summarize that nice and easy. You basically had $10,000 on your income statement. You're going to make $3,000 profit. Sales revenue minus cost of goods sold equals $3,000 profit. You remove the inventory off your books, and you recorded the cash that you received. Done deal.
Okay.
Cool?
Yes.
I don't want to rush that. If you have a question, ask it now.
No, I get it. I was just getting hung up on the entry.
Yeah, well, you know what it is? You probably never really, I mean, it's been a while probably since you've seen these entries.
Yes. Yes, yes.
And it's amazing, right? Because you're sitting there struggling with cash flows, not knowing that your problem had nothing to do with cash flows, it had to do with the basic entries of accounting.
Yep.
So
I need to go back to 101.
No, it's fine. But trust me, what we're doing here is going to be enough. This is 101, 102, 103, 104. I mean, this is all the way through the top in terms of the most complex of accounting stuff.
Okay.
Cost of goods sold, $7,000. So where's that? Boom.
What happened to my screen? Okay.
Right?
Yeah. It's an extent. Okay.
What's my inventory? Down.
7,000.
It's a decrease, 7,000. Always tell me the truth on what happened in each account. Okay, so basically your cash impact was 0, and you are showing me that you have a $7,000 a negative cash flow. Is that right?
Yes.
Is that right? Did my two numbers equal?
Nope. So that means you need to add it back.
So an inventory decrease means you have to add $7,000. Do my zeros match?
Yes.
Bingo. Welcome to the other side.
Yes, because one's a balance sheet account and one's an income statement account. Okay.
Yep.
So
so you're right. So notice that now when we start to go through some of these questions, we're going to have to distinguish, but you don't have to really think. I mean, you can start to think about that in your head and do it without having the training wheels. But I don't even bother. I just do the entries. You can literally, you don't have to go, I mean, you don't have to use an Excel document. I literally, on your board or your paper, your scrap paper, draw 3 boxes. And do what I'm doing right here.
That's what I'll do. That's very, yeah, I like that.
Okay? So,
okay.
Now, so now we have a positive $7,000 of cash flow, right?
Mm-hmm.
Okay, so I'm going to come over here, get my little trusty pen, put $7,000. Next.
Next is accounts payable decreased by $8,000.
All right, let's do it. So accounts payable decreased by $8,000. Let's do it. I'm going to erase all my previous nonsense. Okay, accounts payable decrease. On you. Where do we go?
Okay. So accounts payable is a liability. So you do a negative. Is it 8,000?
Good. Now what's the next?
Credit liability and okay, accounts payable.
So what did you do to? So what's the other side of the entry, or what's the other?
Cash. I mean, I'm paid cash of 8,000.
Right.
Right.
What do we got?
So it doesn't match. So you got to add that back.
Be careful. Hold on. Do you see something wrong with this?
Oh, yeah. So one's a debit, one's a credit.
Okay. Be careful. How do you decrease accounts payable?
Oh, yeah, you debit accounts payable.
Okay. Now what?
So you have to add the 8,000.
Well,
back.
Let's see. If I come over here and I say accounts payable decrease, and I put over here
Oh, okay.
$8,000, is that right?
No, you have to subtract it.
Oh.
So you have a negative cash flow right now with the 8. Okay. Because cash went out.
Cash went out, but nothing impacted your income statement. Therefore, you just got to record the cash going out, even though your income statement has nothing going out.
Okay. Okay.
Don't worry about it. We got plenty of practice coming up on this. This is where practice makes perfect. Next.
Depreciation expense was 10,000.
So, what are we doing?
So you're doing accumulated depreciation and depreciation expense. So you would credit accumulated depreciation, 10,000, and debit depreciation expense.
I got to remove that from the last one. Okay, what do we got? They match?
They do not match, so you need to take that out.
Be careful. This is I'm literally following what you say, so because I don't want to sway you. This is an expense, right? It's a credit.
Yeah, it's a credit. So you need to add.
Excuse me. This is excuse me. This.
It's a.
Go ahead. Tell me what it is.
It's an expense, so it's a debit.
Good. It's always
Yeah.
recorded in terms of expense. Ooh.
Yes.
And this is a contra account.
Contra, yes.
And a contra account is really a positive subtraction. Right? Or no? Doesn't really matter, because all you're really trying to capture, you can leave it at that. I understand why you're doing a negative. You can leave it as negative. It's okay. Okay. But what's the point of this?
The point is to see how it affected cash.
So now you got to do.
Is add it back.
Cool.
Cool.
So what's the?
Add this.
So it's 10,000.
Mhm.
Positive.
When you had a gain on disposal of equipment was recorded.
For how much?
4,500.
Good. So we were saying before that you have gain on sale means that you have cash proceeds, right? Then you have carrying value. Then you have
the gain
on sale of 4,500. So we'll remove cool. And then what else do you do? Now notice that the proceeds would go into investing, but that's not the question. The question specifically says operations.
Okay.
So you don't have to worry about this. We don't have values for it. They didn't give you values because you don't need it.
Okay. So you need to take that back out because there is no cash.
Cool?
Yes. Yep. 0, yes.
Now read it. What's your total?
34.5.
Let's go back
that is
to
5. 34.5.
bingo. Not bad with any memorization, huh?
Yeah.
All right, let's go back. Next question. You ready?
Ready.
I consider this to be one of those things that until you really start to do it naturally, I'm not happy.
Okay.
That's it.
The net income reported on the income statement for the current year was $79,000. Depreciation was $6,000. Account receivable and
up here, right?
Yes.
Okay.
Depreciation was $6,000. Account receivable and inventory decreased by $1,100 and $2,700 respectively. Prepaid expenses and accounts payable increased respectively by $950 and $3,000. How much was provided by?
Right.
Yes.
Let's do it. Where do you want to go first?
So we know depreciation is operating.
Good. So let's go over here. So what do we say depreciation is?
And it's spent.
Right, and we can do it like this. So depreciation, I'm going to get rid of all this stuff. Depreciation is expensed by how much?
$6,000.
Yes. You broke up.
6,000.
Good. So it'll be negative $6,000, right? It doesn't even matter what accumulated is because as long as it doesn't touch cash, you're good. And so then you're going to have to know you're going to have to put in depreciation expense.
You need to add that back.
Boom. So this would be.
The plus 6,000.
See what I'm saying about the training wheels? Once we start to realize that I'm really looking at this number in the cash box, any entry that affects that, any entry that affects that. Okay. Those are the two that I'm always keeping an eye on. So it doesn't even really matter about accumulated depreciation.
Okay, I definitely get that.
Okay, that's what I was trying to say before, that you can, when we start, you want to try to understand it. But as we move forward, now you can start asking yourself what it affects.
How does it affect the income statement?
Yeah, exactly right. So go ahead. So what is this?
Accounts receivable and inventory. Accounts receivable decreased by 1,100.
Okay, let's go to it. What am I doing?
So what you are doing is it's decreased, meaning that you're crediting. You're debiting AR, right? Because it decreased.
AR? Good.
You're crediting AR. And you're
how much?
Getting cash. 1,100.
Good.
And you got cash.
Good.
Of 1,100.
Good. Now what?
So you need to add that.
Now, let me explain this in something that we weren't able to talk about before. But now this is where you see that now your understanding of cash flows is starting to really blossom. Because now I can tell you the reason why we're adding it back is because there was no impact in that income statement.
On the income statement. Ooh.
And since there was no impact in that income statement, the layperson believes that we didn't receive cash.
Wow. Okay.
I'm going to add back 1,100. Cool.
What in the world?
Next question.
Okay, so the next question is inventory decreased by 2,700.
What do I do?
So you would, what did I say? It decreased?
Inventories decrease, yes.
Okay, so if it decreased, you would credit inventories and debit cost of goods sold.
Which way?
Negative.
Cool.
Yes. So we need to add that back.
Does my cash match?
Yes.
It's starting to speed up. That's what I like to see. Next.
Okay, so prepaid expenses increased by $950.
What am I doing?
So it increased, so you're debiting prepaid by $950, and you're crediting an expense. Debiting prepaid. No, you're doing a liability.
Prepaid when you said it was what? It was a prepaid expense increase, right?
Yeah.
So it's an asset, and the asset went up by $950, so it's positive $950.
Right.
And what is the other side of prepaid?
I do this all the time at work. So it's an accrued expense.
So when you pay it, it's really coming out of cash, right?
Oh, yes, $950.
Right?
Right. So you need to add that.
Add it back?
Add it back.
What does that do?
No, you need to subtract it.
Now do they match?
Now do they match? Yes.
So let me explain. I had somebody once tell me, well, Joe, I understand. I thought you can't have a negative asset balance. You're right. But for purposes of using this method, you have to ask yourself, what is the impact? I'm not saying what the balance of cash is. I'm telling you that the impact to cash was a negative 950, which means that it decreased it, which means you got to decrease my cash flow.
Correct. I understand that concept.
Yeah, and that because people have asked me that question before, and if you're looking at balances, it's a different conversation.
This is isolating them, though, right?
The isolation is what it's all about. If you can isolate what, and that's the point of what. Notice all these questions. What I'm doing is isolating each one, attacking them separately, taking the information that I derived, bringing it back to my little home base, which over here is what? Negative 950.
Yes.
And then getting the total.
Mm-hmm.
You probably never, when you were doing these questions in the past, let me ask you, now that we've done two, the classification questions, they're always good to do because it helps you, it's an introduction, right? But then what you start to realize is that it's not about classifying, it's about the attack format, right? So when you were doing these questions, you were probably all over the place. Am I assuming correctly?
Yes. Yes, I was.
Do you see how, no matter what the question that we do, how methodical we are?
Yes.
That's the way you need to
Very.
be. That's the way you need to be. Okay.
Okay.
Last one.
And
what is it?
Accounts payable increased by $3,000.
Okay, hold on. What do we got? And by the way, you don't really do it based on journal entries at this point. You always do it based on net impact.
Okay.
So before, when we did the accumulated depreciation, you were trying to give me the entry, which would have been a credit, but accumulated depreciation went up. That's why it's a positive.
Gotcha.
Okay?
Okay.
I just want to clarify that because now I'm seeing what you're trying to do. So what we're trying to do is we're determining impact. And impact is real simple. It's easier than journal entries. Did it go up or down?
Oh, okay. Impact up and okay.
We started off the conversation going into entries because that's the way I wanted to revitalize your experience with these accounts.
Okay.
But now that you understand the accounts, you can branch away from the accounts and just go into what happened.
Okay. So
quicker. I mean, we're shaving off seconds every single time. By the time we get to the next question, it should be even quicker than this. So go ahead.
So accounts payable went up $3,000.
Accounts payable went up $3,000. Okay, so
up $3,000.
Accounts payable.
Mhm.
That's liability. Went up $3,000. Boom. What's the other side of the entry?
Did I get inventory or something? If AP went up.
How does AP usually go up? What is AP?
AP is a credit account.
No, but what is it?
It's a liability.
So you owe somebody money.
Right. So that means I got an asset.
No.
No.
If you have an accounts payable, usually accounts payable, trade payable, right, means that you have an expense. I get an electric bill. I don't pay it. My accounts payable goes up.
Yes.
So what's the other side? So what happens to my expenses?
My expenses go up. So I have to add that back.
Let me explain what happened here. So you're right. I just want to make sure you get this. Cost of goods, well, this is, it's just going to be expenses generic because we don't know what it was. Okay?
Okay.
It could be a utility, it can be anything. But the point is that I have expenses that hit my income statement. So my net income went down by $3,000, but I never paid them. It was an IOU. So in reality, my net income says that my net income went down, but my cash stayed consistent. There was no cash impact. That's why I have to add the $3,000 back. Because if I don't, right, because the layperson would say, well, okay, Joe, you have net income of $3,000. That means you don't have $3,000 in your pocket anymore. Wrong. I didn't pay it. So, of course, I have the $3,000 in my pocket. Add it back. Now my zero is zero. So I'm removing the effect, unwinding the effect that the expense had because I didn't pay it. You with me? If you don't, please tell me.
No, I'm with you. I'm just looking. I'm with you.
So now what do you do when you sum them all up?
Okay. So is that a 6? Yeah.
Yeah, I know. My handwriting's atrocious. It says, what, this row here, 6,000, and this is a 1,100. And this is a 0.
79, you add 6. We're adding 1,100. We're adding 2,700. Subtracting 950. And we're adding 3. And 90,850.
Let's go back to the other page. What did you say it was?
B, 90,850.
Bingo. Not bad, right?
Not bad. So I can use that tool to answer these questions. Like I would draw do I need to just try to remember the impact on the income statement, or can I use that tool?
What I would do is, if you want to create the Excel, I created it with you. I'm going to send it to you. You can use it,
Okay.
and I want you to use it. But my suggestion is you don't want to get stuck where you're looking for the Excel document on game day.
Right.
So, listen, if it's a simulation, you're going to have an Excel tool and you can create it. But more likely than not, I created that Excel document for you to see the impact.
Okay.
I want you to try to do it on your own. I'm going to show you what I want you to do starting on the next one.
Okay.
We'll do it together.
Okay.
Okay. So, if I'm you, it's going to be hard to do without. I'm going to tell you what I'm going to do, okay? I'm going to do it in Excel, but without the formulas. So this way, pretend this is my piece of paper. It's just if I do it in handwriting, it's going to be atrocious. Okay?
Okay.
So I'm just going to do this. Pretend that I'm you, and I'm going to just do 3 boxes. Cool?
Yes.
You're drawing those out the same way that I am. All right?
Okay. I'm doing it now.
Tell me when you're ready.
Okay. Martin Company had net income of $70,000 during the year.
On the start of your page, put 70,000 at your top.
Okay. Depreciation expense was 10,000. The following information is available. Accounts receivable.
Well, don't even bother because you know what you're going into.
Okay.
What are you doing?
Depreciation expense is on the income statement.
Hold on. Okay. So depreciation expense is where?
On the income statement.
Of how much?
As of 10,000. So it'd be a negative 10.
Next.
I need to add that back.
Good. Done. Next. See what I'm doing? You don't need the sheet.
Yes.
It's the theory of the sheet that makes you get the questions right. You visually are doing it even though you're not doing it.
Yes.
Next. Oh,
I need to go back to the question.
Yeah, sorry. You're not clairvoyant? Okay, go ahead.
Okay, and the accounts receivable increased 20,000.
So accounts receivable increase. Where's that?
So that's on the balance sheet. AR increased 20,000.
What's the other side?
A sale and the income is 20,000.
AR increase. Good. Sale.
There's a plus, right? There is no cash to that, so I need to subtract that. Minus that out.
Done. See that?
I see it.
You sound surprised.
Yeah, I am surprised that it's
why? Because
working.
Yeah, well, thank you. I guess it's a compliment. Is that what you're trying to say?
Yes, sir. It's like, wow, okay, wow, I'm not memorizing.
No, I know. I know it bothers you because you're used to, and I can hear in your voice.
And
I always get this.
I want to memorize.
Yeah, you want to memorize, but not only that, you feel like you're doing something wrong. You're like, wait a second. How the hell did I get through all of this without memorizing a stitch?
Right.
And you're probably trying to do these questions racking your brain.
Yeah.
And now you're just doing it like it's natural.
Mm-hmm. So equipment gain on sale increase of 10,000. Equipment gain on sale increase. What's that mean? That just means a gain on equipment, right?
Yep. What am I doing?
So we got a gain on equipment.
Up here, right?
Yes. It'd be on the income statement, 10,000 as a positive number.
Good.
So you want to subtract that out.
Oof.
And non-trade notes payable increase of 50. So you're creating an expense.
So non-trade means that it's not related to the income statement. So let's just talk about this real quick. Okay. So a trade payable means that you're in the business of buying and selling, and you have an expense. As a result of that expense, you have a payable. Okay. Non-trade, okay, means that it's not related to your business operations. It's related to maybe almost like a loan or something of that nature.
Okay.
So does that sound like it's operating?
Yes. It's investing.
Financing.
It's financing.
Because I, instead of getting monies for the actual, what was the what do we say the definition of financing was? I don't want to tell you.
Raising
Capital. If my notes payable went up, I got cash.
You got cash, yes.
And a liability went up. So it would look like this. Hold on. You're going to get curveballs. That's fine. That's what we're here for. Okay? So it would look like cash, positive, how much? $50,000. Liability, non-trade, pay, went up 50,000. Right? So you're right. You have to do something here because you did receive cash. Just not under operating. It would be under financing.
That would be under. See, even if it wasn't operating, if it asked for investing, when you said that, I was like, okay, well, that's investing and not. Okay, fine. I wouldn't have thought. Okay, that it was fine.
Understand that the purpose of financing is for you to receive money. Investing would mean that I paid somebody money to obtain an asset. That's not what they're saying here. Here you received cash, so it has to be a finance.
It has to be a finance. Okay.
Cool?
Yes.
So that actually goes into financing, so it's not in our question.
Okay.
Cool?
Yes.
Next.
So prepaid insurance increase of 40,000. So that's the balance sheet count prepaid. So you would debit cash. No, you would credit cash and debit prepaid.
Good. So cash went down.
But
Negative.
it's not reflecting.
Oh, you said the magic words.
So you need to add it.
Now be careful. So what? So this is prepaid insurance, right? So it would be a decrease in cash.
Oh, I'm sorry. You need to subtract it out.
Yes. Which means that prepaid
went up.
Went up.
40. And cash went out, but it wasn't showing on the income statement that it went out.
Good. So you have to
subtract it out.
Cool?
Yes. And accounts payable increase. Means you got an expense, which was subtracted on the income statement of 30,000. So it means you need to add that.
So expense goes up?
Yes.
By how much?
30,000.
I know I didn't get any cash, so I don't care about the other side of the entry. So I know that I have to
add that back. And 30 is 40. Oh, the answer is B, 40,000.